What's up everybody? I'm gonna go over my GME call that I just sold off. In a previous video I said that I would review the trade when it was done, so I'm gonna go ahead and do that now. I bought the GME $25 call expiring January 15, 2027. I paid $380 for it. So what that means is I bought to open a GME call with a strike price of $25 and it expires on January 15th, 2027, and I paid a premium of $380. I eventually sold to close my call and I received a credit of $435, making me a profit of $55. I wanted to show you guys how this would have worked if I bought $380 worth of GME shares. On December 12th when I bought the call, GME closed at $21.89 a share. So we're going to use that as our cost basis for this example. So 380 divided by 21.89 would have gotten me roughly 17.3 shares. On January 22nd, I sold my call, and the closing price of GME was $23.14 per share. So my 380 turned into 432 for a profit of $20.32. So let's compare the two. The call netted me $55 and the shares would have netted me $20.32. Now I know what you're thinking. But this is where the magic of options is on display. With the shares, it's pretty straightforward. The share price goes up $1 and you make $1 based off how many shares you have. But with call options, you gain value in different ways. Call options are made up of intrinsic and extrinsic values. I'm going to try to crudely explain intrinsic value now. Intrinsic value is how much above your strike the share price is. So for my call, the share price was $23.14 and the strike price was $25. I had no intrinsic value. Think of it like this. You have a coupon for a product and the discount you get is based on how much the product is selling for and how much your coupon says you can buy it for. Depending on the value of the product, the value of the discount can change. My call acts like a coupon to buy a thing at $25, but the value of the thing is only $23.14, so I have no discount at all. Now let's say I have that same $25 coupon, and that thing is now valued at $30. The discount I receive is $5. So when you take that example and apply it to calls, the more your call is in the money, the more intrinsic value you'll have. Keep in mind, a call controls 100 shares, so that $5 is really $500. Now let's explain extrinsic value as seen through the eyes of an amateur trader. Extrinsic value is made up of time and magic, or as I know them as the Greeks. The Greeks sound more like a fraternity name, but they can make or break your account in a snap. We're going to go over delta, gamma, theta, vega, and rho. Delta is the probability of a call expiring in the money. When this is high, your extrinsic value is high. It also tracks how much value a call will gain for every dollar the underlying security goes up. Most traders look for a 0.70 delta to minimize risk, but do with that what you will. Gamma, the rate of change for delta. As this increases, it increases how your delta gains value. So as this goes up, your delta will go up, and so will your extrinsic value. Theta. Theta is known as time decay. This rate goes up as your option nears expiration. All options expire. They aren't like stocks of a good company that you can just hold indefinitely, so be careful. They will expire. Vega. Vega is volatility sensitivity, which is ramped up or down by implied volatility. The IV was low when you bought it and jumps high, your intrinsic value increases. The opposite can happen as well. If IV was high when you bought it and it drops dramatically, your call will lose value accordingly. Rho. How sensitive a call can be based on the risk-free rate. As rho increases, extrinsic value increases slightly. So let's look at my call. It was long dated, so it had a lot of time value on it. There was still theta decay on it, but it wasn't as much because of how far out it was. It was out of the money, so I had no intrinsic value at all. Any gains that I did get were based solely off of the intrinsic value going up because of the Greeks. In summary, I made this video to show how calls move compared to shares, but options are risky. They can move higher than shares, but they also run the risk of expiring worthless. If you're going to trade options, do way more research. That's all I have for you. Thanks for watching. See you in the next one.